Contrary to popular belief, this has been one of the easiest Bitcoin bull markets to have invested in. Now, the cycle's not over yet, so there's still potential further upside. And if we can strip back all of the emotion of the game, the crazy expectations, then hopefully we can still make the most of what is left in this cycle. Now, if you like hopium-free content, basically nothing pumping you up the rectum with what can happen next, check out TIA Premium and TIA Crypto. Link to this is in the video description. It's our educational programs for trading and investing in crypto, Bitcoin, stock markets, and the real estate cycle as well. Now, in today's video, I'm looking at market sentiment data, in particular, economic data. Interest rates is going to be one of the big ones for today's video, and market cycles we can see here. So first things first, investors should remember that their scorecard is not computed using Olympic diving methods. A degree of difficulty doesn't count. So most people think that things are going to be overly complicated to get the best result out of the market. That's not been my experience over the last 20 years. I have made things extra complicated in the early days, and sometimes I still consider I do make some complicated decisions, but we want to strip that back and make things super simple. So starting with that, just looking at the emotions first, the market sentiment, which we can read in the market with the fear and greed index. The first thing is the wild swings of the prior cycle. Now, of course, we don't have the sentiment data for the cycle before that, but looking at the 2021 peak, that cycle, you can see how much fear there was in the market, the runs up into extreme greed, and then dumping again into extreme fear, a bounce, more extreme fear, and then back into the extreme greed before it dumped yet again, extreme greed into extreme fear, and again. Basically, you can see this whip soaring of emotions, whereas this cycle started out very, very clean. Slight moves up, small pullbacks. Slight moves up, smaller pullbacks. And it's only in this later stage of the cycle that we're seeing wilder swings. And this is to be expected towards the end of the cycle. But moving into that first part, we've seen a very balanced market, which I think has made up a good ending for this stage of the cycle. The other thing we note is the dopamine rushes that you get when you get those wild swings in the market from basically boring times into FOMO times, when everyone just needs to rush into the market because they're missing out on the latest price gains. And I think that is pretty well what young markets are good at. Altcoin markets, young markets, meaning stuff that is new, stuff that is just coming out into the space. In the case of Bitcoin, when you compare it to the stock market, it's still very much new. Dow Jones has been around for over 120 years. The S&P roughly over 70 to 100 years, depending on which S&P we're looking at. There was an earlier one, plus the one that started in the 1950s. And then, of course, the NASDAQ in the 1970s, so over 50 years there. So it is a relatively young market. It attracts young investors, it attracts new investors, and that always leads to wild swings in the emotions. And what I've noticed is they love the dopamine rush. Who doesn't love a dopamine rush when you're trying to make some money? But in this cycle, we've seen a lot of balanced moves up. There has been the dopamine rush to the highs, but then the balance corrections that come back and retrace the entire move. And this is sustainable for a bull market. What's unsustainable are the moves that don't get retraced, that don't see the price area tested again for that bull market. And eventually it has to come back to test that area. Now, it's not to say that these areas won't get tested in the future, but for this current bull market, a lot of that price has come back and been tested. So we're looking at this as being a balanced move. So that's the first thing, looking at sentiment and how that relates to price action. The dopamine rush of the market just running up, never coming back to test those prices, creates more and more FOMO because people are missing out, and it doesn't look like there's going to be that chance to buy back the dip. And so far we've seen that. So it's, on the one hand, balanced. It can sustain the bull market. We're going up. On the other hand, if we start seeing no more tests of the price ranges, that's when we could start to say there might not be that much left in the market. And even though this one here in 2021 happened in the first half of 2021 and the top wasn't until the second half of 2021, you can see that the emotions ran hot in the first half, big correction, and then the price really didn't take out that prior top. So essentially, the top was roughly around the same, and then of course the market crashed from that point. So the emotions got carried away in the first half. This time it doesn't seem like the emotions have been carried away as much. And a good example of that is the S&P 500. So I've got the rectangles here on the chart, and this is the futures market, goes back to 2000. Basically an example of how the market is able to keep carrying on. It looks like indefinitely, but of course things always come to an end. But you can see the market just running up, taking its time, coming back, testing prior tops. In the case here, 2015, it ran up for a few more years, came back. Yep, COVID happened and basically came back and tested those highs, and then it ran up again. So we had the 2021 top, 2022 bear market, came back and tested the breakout point of the new all-time high prior to the COVID dump. So the pre-COVID top was tested, consolidation, and started to move higher again. And then we had another fearful event. The tariffs happened, came back, tested the previous old all-time high of 2021, 2022, and of course we've now pushed to new all-time highs. So we're seeing the markets test each of these prior tops on the way up, creating a balanced market. And what you could say, and I'm almost hesitant saying it is, but a second opportunity to buy that dip. And I'm hesitant in saying it because although it's there technically, doing it in practice is another completely different ballgame. So it's not to say that this is like the easiest thing to do in the world, but we've seen the ease compared to the prior cycles where the market has come back, balanced out the move with the retracement of the move to the upside, and then it's able to continue to climb higher and higher rather than sort of shoot up and then the price not go anywhere, or shoot up at the top and then the price not go anywhere either. So comparing that, looking at the market sentiment, it also happened in 2013, big blow off move from a couple $100 up to $1,200, and then of course the whole move was retraced as well. The other balanced data that I'm looking at here is the number of months that were red throughout this entire cycle. So if we take a look at the 2013 cycle, that's the big blow off move there into the top of November, nearly 500%, or over 500% when you compare, add in October and November. But to the point, 2011, 1, 2, 3, 4, 5, 6 red months, 2 red months, and then 2 red months into the top, because the top was 30th of November. So we could say 2 there, and then the bear market started in December. So from that top, the bear market happened, and that ran all the way into 2014. Taking out the bear market years, just looking at the 3 years of the market going up, we have 1, 2, 3, 4, 5 red months, meaning there was 7 green months, 1, 2, 3, 4 red months, and then you get into that final year, things go crazy, basically just 2 red months. Last cycle, we had 6 red months, 4 red months, and then 5 red months. This one here was added into the bear market year. And then the current cycle, we're seeing 3 red months, 4 red months, currently into our 3rd red month with about 4 days to go in August. So if this does happen to remain red, you got a pretty well balanced cycle here with 3 to 4 months and each of the bull market years being red, and then the other 8 to 9 months being green, marginally green. You can see here only 0.03, 0.065. June was only 2%, 3% last year. So you can see there are some marginal ones, but it's been relatively balanced that entire time with any of the moves going up, coming back, and having that 3 to 4 months. Now, the other big one that I've noticed is the interest rates. With all the talk of interest rates this cycle, we bring up the interest rate chart here, all the talk of where the interest rates are going and not going and how they have to be cut and over and over and over again. And finally, maybe we'll see a cut in September after so many months of it not being cut. The interest rate is essentially the exact same as it was at the beginning of the cycle. So this whole cycle for Bitcoin has occurred with the interest rate slightly going up from 4.5 to 5.5%, then back down to 4.5. And of course, next month it could be 4, could be 4.25. The point is, at 18K, when Bitcoin was at 18K, that was around December, the low, a week or two earlier on the 21st of November, Bitcoin around 18K, the interest rate was 4.5. And now Bitcoin's around 111. It was last month about 118. So here is in July. There it is, around the 118 as it consolidated. And the interest rate was still 4.5%. So through this whole cycle, it's risen up 1%, come back 1%. So again, one of the most balanced bull markets we've seen, compared to something like 2017 where we had 0%, and 2015 was the start of the cycle, 0, ran up to 0.5%, and then we got into 2017, ran up to 1%, July 1.25%, and then to this top here around 1.5%. So there's been slightly more, it's more interest rate increases through the 2017 cycle than what we've seen now. But in terms of a percentage move, of course, coming off 0, you can't really measure that, but it's been a huge percentage jump to 0.5%, to 1%, to 1.5%. But in terms of the market psyche, that was a lot, considering the interest rates were 0 since 2008. So they've been 0 for about 7 to 8 years before they started to climb. So everyone got used to this 0% interest rate environment. They, of course, climbed from there, and they kept going into 2019. Of course, came down in 2020 with COVID. And since then, well, we've seen a similar sort of thing. In 2021, they dropped off a cliff. That was the 2021 bull market cycle. So they dropped off a cliff into March 2020, stayed at 0 for the remainder of the bull market top, and then they started to climb for the bear market of 2022. So we got to near to the top, and then the cycle starts again, and we've had relatively stable interest rates from that point. Now, overall, they're historically low. People only look at what's going on in the last few months, sometimes few years, but what you really want to look at is the entire history and have a look at how this stacks up. And of course, 40 years ago, 45 years ago, interest rates were up around 20%. So this is just a bit of a side thing for anyone watching interest rates over this coming period for the rest of the cycles. We might have to start getting used to higher interest rates. So although there's all this talk about them, they have to go up, they have to go down, whatever people believe in order for the market to progress, it's likely that even though we may see some cuts throughout this cycle, we'll probably likely see further interest rate rises, especially when you're looking at the 40-year history of interest rates overall. So don't let that throw you off investing into the next cycle. Interest rates don't need to be at 0 for markets to go up like they weren't in the past. You had the 80s boom. They were coming down, but they were still relatively high there, above 6, 7, 8% into that peak of the 1990s. They came down in the recession and then started to consolidate around 2.5 to 6%. They came down again in the next recession, and they went up again. If we look back 40 years as well, with some of the more historic data, they were basically on the rise for that 40 odd years into the peak of the early 80s, late 70s as well. So interest rates, much, much, much longer cycle, bit of a extra learning there for this next cycles that come up, and not to let it put you off any sort of investing moving forward, say for the stock market, for real estate, and potentially if, hopefully, as we all hear, maybe Bitcoin is still around at those times. So price action and market sentiment are suggesting this has been one of the most balanced markets rather than the most difficult markets. And I'll put that down to many investors thinking that markets have to run hard and fast to the upside, and they're not necessarily used to the patience and the balanced, sometimes balanced nature of markets, which causes them to call this thing sort of the hardest markets to trade. And really, I think Buffett's quote here is just pretty simple. The degree of difficulty doesn't count. If you're just watching and taking some of the easier trades rather than the difficult stuff, Bitcoin, as we know, is now up 700% from the low. Many altcoins may have done that, but have retraced a lot of those gains, and some of them never even did 700%. People are looking for 2 or 3 or 5x's. This thing has 7x'd since those lows. So I think that's another lesson in just sometimes making life a hell of a lot easier for yourself. Market sentiment, price action, moving up, retracing those moves. Monthly returns, pretty well balanced here, 3 to 4 months to the red. Next is USDT dominance. So this is what the USDT dominance looks like in the background with the white bar chart. The orange line is Bitcoin. So we'll turn that off for now and just have a look at the balanced nature, or basically the movements of the stablecoin through this cycle compared to the last cycles. And so this cycle is in this box. This one here at the top, this higher box here, is the decline and then the consolidation before the breakdown of USDT dominance, which is that breakout for Bitcoin. And since that point, basically USDT hasn't necessarily gone anywhere. And if I had to add one reason for the other side of the argument being that this is the hardest bull market, this would have to be it. In prior cycles, we've very much seen big swings in USDT dominance. So basically a whole lot of money flushing out of stable coins, of risk off into risk on, cryptos and Bitcoin, of course. And then when it gets to a point, consolidates, then rushes all the way back into stable coins. And in terms of a percentage move, they're quite large there. You're looking at major swings, 200 or so percent, whereas this time from the highs to the lows, 60 odd percent. If I want to take it from the extremes, 70 odd percent, and then back down. So this would be the hard part, where we haven't seen all that money flow out into other altcoins, and basically the entire market's like what has happened in the past with these much bigger swings at lower percentages of the market cap. This time it's basically been trading between stronger assets and Bitcoin. Bitcoin back to those other assets, then back to Bitcoin, back into stablecoin. So Bitcoin has really seen the easy move to the upside here: market sentiment, price action, and stablecoins, basically the risk on environment. People just looking at going for Bitcoin and then back into stablecoins. And that's represented here on the chart. So barring everything bar this breakdown, that's pretty much been the trading range for the stablecoins compared to previous cycles. Big moves up, big moves down. The cycle started obviously end of December of 2018, and then we saw the big swings begin. Nice big swings until the market broke down, bear market began, and of course stablecoins started to consolidate at these highs, distribution taking place, accumulation for Bitcoin and some of those altcoins, and then of course a breakdown, and here we are. Find ourselves right here for BTC. Now, cycle analysis has also shown that this cycle has been similar to a composite of the last 5 and 10 year cycle for Bitcoin. So the COVID era, the 2020 move out of the low, and then also 2015, which was a consolidation, the accumulation up to that 2017 bull market. And so it's been tracking relatively the same for those 2 years. And if you combine them together, which we alluded to earlier in the year, once we had a significant event like the tariff crash into that low of April, things started to play out very similar to that year. And so we've been able to track this on the way up. Again, I'm not trying to say that this was, everyone should have seen it. It is a work in progress as well. So trying to remain humble on this as we just follow the charts as well. I don't think we can necessarily say that this has been the hardest cycle of Bitcoin this year. In which case, what comes next? Ideally, we see the consolidation into early part of September, maybe a higher low here in late September or early October, like the cycle is suggesting, and then we start that next move to the upside. So combining everything that we've talked about in this video already, if we are to see that play out, and we, for Bitcoin at least, don't see retraced moves that balance out these moves to the upside, what does that mean? Big moves up, and we don't see them come back and retrace to test these levels. That could be the blow off top that people are expecting. But every blow off top, like we've seen before, if there's no testing of the prior moves, that typically leads to the end of the cycle. How much longer is that? Of course, that's the next $100 million question, but that's the idea that we're watching towards the end. If we get these sort of dopamine rushes up without any sort of retracement and much higher lows and things happening quicker, probably good signs that the cycle is nearly over. So timing wise, 1,000 days into the cycle, we've got to be on red alert for any of those extreme sort of moves to the upside. Along with the price targets, we'll have a look at the percentage increase on these price targets. So the lows that we're concerned with are the cycle low, 15K for round numbers. The August low of 2024, roughly around 49K. And then the April tariff low in, obviously April 2025 at around $74,000. Now, each of these lows are going to be connected to the extreme of the move. 74 for the first cycle, 109 for the second, calling it cycle here, but the second wave. And then for the current wave top, we've got actually this one here. So this is the May top, because we haven't necessarily seen this end. And if this does change with the current price action, maybe we see some pullbacks, then we might use that as our reference points. The low here, the top here, and then the pullback. But for now, this is the reference point. And if we add those to the chart, first being the 130s is what we're watching. We've hit the 100 mark dead on. So this was the range, top to bottom. August, the market ran up, Bitcoin ran up and hit dead on the 100%, pulled back, and it looks like it wants to have an attempt at the mid 130s. Let's layer the next one in. We hit the 50%, but haven't necessarily got to the 100% yet. And it's a good thing to see these price targets overlapping each other, which essentially create a price cluster, which, from what history has shown, markets can get drawn a little easier to those price clusters. But on the flip side, they can act as much stronger resistance levels. So that's why we're on red alert at the moment for the mid 130s, mid 160s. Let's keep adding to that, and I'll show you an extra one that also adds to this analysis. So we've got the shorter term time frame here. So again, if it's shorter term, a little bit of it has less weighting than the last two, which are larger, but I'll get to another large one in a sec. 74K to 112K, so this smaller move here. It's hit 50 and rejected. So if that's the case, there is the chance that we do come down and test the the high 90s, around that 99 to 100K. But at the moment, let's run as is before we have to do any sort of readjustments here with that top. Using what we have, the mid 130s comes up yet again at 100% extension of this shorter term range, and nothing extra for the mid 160s. So now we add in the total of the first range from the low to the first time we hit a new all-time high. And this one's just looking at the fib retracement, but then the doubling of that fib. So this range here, just projected on top, 200% comes out at almost to the cent, $132,000, which lines up with every other price extension that we've used here. So if I zoom in, just make this a little bigger, you can see the numbers: 132, 134, 136, 137. And that's rounding up to the nearest $1,000, which is pretty damn close. Give yourself an average there, somewhere in the mid 130s. That's why I think this one here is pretty important, especially if we are able to pull back here, consolidate at those higher lows, giving a balanced market, and then wait and see whether we can push that a little bit higher into all of these levels. Or on the flip side, we slice through and move towards the next price targets above. And those next price targets, barring the 140s, 150s, round numbers, psychological levels, we've got another interesting one here coming out in the mid 160s. So this is the 261.8%, so another important fib number there, 61.8. This time it's on the doubling plus the 61.8%. That comes out almost to the dollar of $168,000. The 200% comes out at 166, and the 150% of one of the ranges down here is at around 164. So average that, 164, 166, 168 gives you an average of around 166. So that's why we're looking at in the mid 160s here, and then this one back here around the mid 130s. So that's a look at those price targets. If you want to dive into that a little further, I've given this video back here a few weeks ago now, Bitcoin and Ethereum top price targets for realistic and conservative. We're not trying to blow any smoke up anyone's ass and make people wait for huge numbers. We're just following the trend. Price targets are in mind. Doesn't mean that that's going to be the only price they get to. Price targets are just there as part of our trading plan. And the video before that, a few weeks ago now, the August rally and crash, we've obviously seen that now. We've seen the August rally, we've seen a crash, but it seems like it's still in this balance phase. And Michael also did a fantastic video looking at 3 red bars. So this is getting a little beyond the scope of today's video. I suggest checking out the video description, check out Michael's channel, and this particular signal here of 3 red weeks, different to the 3 bar rule that you may have heard us talk about on the channel. 3 red weeks near a high generally leads to another correction. 3 red weeks near a high, another correction. 3 red weeks leads to a correction, so on and so forth. Now, he goes in that in a little more detail if you want to learn more about it and use it for your trading plans, which I think is a fantastic idea, especially at this late stage of the cycle. So there are several reasons why I think this cycle has been one of the easiest in hindsight. In practice, trading and investing is never that easy. If it was, well, of course, everyone would be a millionaire and there would be no losers out there. So it's just a matter of trying to make things as simple as possible, stripping back what's not working for you, and just add into your own trading or investing plans what is working for you. And that's just a continual process over time whereby you're finding things that are working. Sometimes they're working for you. Maybe you outgrow them. Maybe you need to improve them. And then you're adding in other indicators, other signals that you think have a better chance of working. And in that case, you need to strip it back, make it nice and simple for yourself, because at the end of the day, you want to have some time to go and do other things and not be stuck in front of the computer all day. So links in the video description for TIA Premium. I think this is probably the easiest bull market. And yes, that's saying it in hindsight. Let me know how you have been trading at this cycle. Love to hear from you guys as well in the comment section down below. Like and subscribe as usual. Thanks to Buffett giving us all of his words of wisdom when it comes to the degree of difficulty in trading. If you want to have a look at that, go and check that out. The degree of difficulty, search Warren Buffett and Charlie Munger. A pretty interesting article here that came from their 2005 annual meeting, and that just got me thinking about the markets in general. And if that wasn't enough, a couple of videos there to watch. Price targets, realistic and conservative, and then of course the August rally and crash. I'll see you guys back here at the next video. Have a fantastic day. And until then, take care. Peace out.